Procter & Gamble reporting earnings of $1.40 a share. That was 3 cents better than estimates. Revenue of $20.53 billion, just shy of estimates. Join us now, Procter & Gamble President and CEO Jon Moeller. Always so many things to delve into, Jon. Can I good to see you, and welcome to the show.
Likewise.
You're not. I wish you were right here with us. But for the first time, would you say that there is some pressure on consumers, whether it's pricing, perhaps whether it's in China, to account for this? I know there's currency headwinds, there's commodity cost headwinds. It's always a very detailed report with a lot of numbers. But what really happened? And are these good numbers in your view?
Well, first of all, I'm looking forward to seeing all three of you in Paris tomorrow, and we can catch up on even more detail at that point. But we just finished our fiscal year. I'll come to the quarter in just a second. The fiscal year, we guided to 4 to 5% top line growth. We delivered 4. We guided to 6 to 9% core earnings per share growth. We delivered 12, which is 16% on a constant currency basis. Cash flow, free cash flow productivity, 90% guidance. We delivered 105, which allowed us to increase our dividend by 7%. That makes it the 134th consecutive year this company's paid a dividend, and the 68th consecutive year we've increased the dividend. The quarter was a little bit softer than the balance of the year, and you mentioned one of the key drivers, Joe, which is the pace of recovery in China, which has been a little bit slower than we're expecting. If we look at the other markets, the U.S., for example, and Europe, one of the key questions has been, can you keep unit volume progress going against the context of some of the pricing that you've had to take? Last 4 quarters, unit volume in the U.S., 3,343. In Europe, 2,343. And the other question has been, okay, but can you maintain margin in that context? Gross margin was up 360 basis points, the highest gross margin in 17 years. So we head into next year in very good fundamental shape. We're guiding to 3 to 5% top line, 5 to 7% bottom line, and again, 90% free cash flow productivity.
Again and again, we hear that from China, and it's now I'm just ready to say it's you don't even have to pick your product. It's high end. It's consumer items. There was an initial, the bounce from the pandemic wasn't as much as people thought, or the bounce has slowed, or how do you characterize it, Jon?
Some general malaise on the markets. If we compare current growth rates to pre-COVID growth rates in China, they're lower. We expect that's a near-term dynamic, and we remain very optimistic about the mid- and long-term prospects for that market. We continue to invest in growth in that market, but it is fundamentally a bit slower in the categories in which at least we compete.
Jon, this is a Wall Street Journal, but it's quite a headline. Diapers are a drag for Procter & Gamble. And you'd have done some things, some innovation revamp versions of certain of your diapers. I mean, we got to talk about, if we talk about all your products, obviously we'd need the rest of the show. But specifically, there were some negative numbers in diapers, right?
Yeah, so the premium end of the diaper market in the U.S. and more broadly is doing extremely well. We're building market share, for example, in the pants segment. We're facing some newer, stronger competition in the lower end of the market. The good and we lost share there. The good news is we have strong innovation coming out on Loves as we speak. And we should be able to address that and resume growth on both the top and bottom line.
Jon, you're definitely a total return investment equity. Tell exactly how much did you spend on both buybacks and dividends, and is that what an investor should expect? And that is an unbelievable. Is there anyone else? How many years? And it's going through pandemics and financial crisis. It's going through everything, and you've been able to have the discipline to continually raise it. Is there anyone else? I think you're without peer there, aren't you?
Not really anyone else. So let me just give you a couple facts, and thanks for asking that question. Past 6 years, this team has grown the top line by $17 billion, which is at the 88th percentile of the S&P 500 over that period of time. They've grown the bottom line $5 billion, which is at the 93rd percentile of the S&P 500, and that's allowed us to maintain. We've built $200 billion in market cap over that number over that period of time. All of that's allowed us to continue fueling cash return to shareholders, which last year was about $14 billion. To the question of comparison, I mentioned 134 years of consecutive dividend payments. There are 7 companies that can match or beat that are publicly traded. 68th consecutive year of increase. There are 3 utilities that can match that number. So it really is an important characteristic of the company that continues to attract investment.